By the early 1970s, the United States was facing a perfect storm of economic pressures. The financial burden of the Vietnam War, rising inflation, a weakening trade balance, and increasing demands from foreign governments to exchange their dollar reserves for American gold. All of this was happening under the constraints of the Bretton Woods system, which had been established in 1944 to stabilize global currencies by pegging them to the US dollar, which in turn was backed by gold at a fixed rate of $35 per ounce. As countries like France and West Germany began to lose faith in the dollar's stability and demanded gold in return, US gold reserves began to dwindle. The credibility of the entire global financial system was at risk. In response, President Richard Nixon made a historic and unilateral decision that would reshape the world economy. On August 15, 1971, Nixon announced the suspension of the dollar's convertibility into gold, effectively ending the Bretton Woods Agreement and severing the last formal link between the dollar and any physical commodity. This move became known as the Nixon shock. The announcement stunned the world. The dollar was now a fiat currency, backed only by trust in the US government and its economic strength. Though Nixon framed the decision as temporary, it quickly became permanent, ushering in a new era of floating exchange rates, speculative currency markets, and central bank-driven monetary policy. The immediate aftermath saw global financial turbulence. Countries scrambled to adjust their monetary frameworks. Some viewed the move as reckless. Others saw it as a bold assertion of American sovereignty over its currency. The United States could now print money without the constraint of gold reserves and finance its growing deficits with ease. This shift gave rise to the petrodollar system, where oil exporting countries agreed to price oil in US dollars, further entrenching the dollar's dominance in global trade and reinforcing its status as the world's reserve currency, despite no longer being backed by gold. The Nixon shock set a precedent for future financial maneuvers. It showed that the United States could unilaterally redefine the rules of global finance when necessary. It laid the groundwork for the modern monetary system, where central banks manipulate interest rates and money supply to manage economies, often with little regard for physical backing or long-term consequences. Critics argue that Nixon's move opened the door to unchecked monetary expansion, asset bubbles, and growing inequality. Supporters claim it gave governments the flexibility needed to respond to economic crises and foster growth. The legacy of the Nixon shock is complex, but its impact is undeniable. It marked the end of the gold era, the birth of fiat dominance, and the beginning of a financial world shaped more by policy than by precious metals. It showed that in times of crisis, the United States would not hesitate to rewrite the rules to preserve its economic power, a lesson that continues to echo in today's debates over digital currencies, sovereign debt, and the future of money itself. The Nixon shock was not just a policy shift, it was a global reset, a moment when the foundations of international finance were restructured by a single televised announcement. It revealed the fragility of systems built on trust, the power of unilateral action, and the enduring influence of the United States in shaping the destiny of global economics. As the world moved into the fiat era, the dollar remained dominant not because of gold, but because of geopolitics, military strength, and the sheer scale of the American economy. The consequences of Nixon's decision continue to ripple through every financial transaction, every central bank policy, and every debate about the future of money, reminding us that the rules of finance are not fixed. They are written by those who hold the power to change them.